Good evening, students. Welcome to the live coaching classes organized by Board of Studies ICA. Today's evening, we are going to learn on this topic called types of duties under customs law. Also, we will study on classification, how the rules are relevant to identify the particular HSN for a particular goods imported or exported. Yeah. So today's session is going to be too much of technical for you to understand on customs tariff act point of view. In the previous session, I have taken you through the procedural aspects with respect to charging section. When section 12 gets attracted, what is we need to understand with respect to assessment. So as a protocol, before we commence today's learning, people who are watching me live, please confirm you're able to view my screen. Also, you're able to listen my audio perfectly. Once I get a confirmation from one of you, I will go ahead with our discussion. Mansa, I have received your questions. I have a recap for previous session. So in the process, I'll answer your questions now. I have taken note of your questions. And Purushottam, yes. Any questions with respect to GST, you can feel free to post it in today's session. I'll clarify. Yeah. Thanks for the confirmation, Shiva and Kaushiki. So let's begin with our today's discussion. Mansa, just wait for another 2 minutes. I'll come to recap to answer your questions. In today's session, as I said in the initial beginning, we will understand the various duties: customs duty, additional duty, anti-dumping duty, countervailing duty, safeguard duty. There are various duties which are levied under provisions of Customs Tariff Act. So I'll completely take you through the Customs Tariff Act for making you understand what sort of duties are levied. Also, yesterday, previous class, I've explained the taxes, why this IGST will be levied, what is the purpose. I've given one example. I'll take you through the calculation of those taxes also. And in the process, every duty, I'll make you understand why, what is the backdrop for levy of a particular duty. In the process, as an importer or as a person who's exporting from outside India, what are the rights and remedies available to them? And last, I'll touch upon the classification rules. These rules, not that important from your examination point of view. But post-qualification, if you're looking for specialization in indirect taxation, then this is going to be a very, very needy for you. And as I promised, in the previous class, I have shared one Word document where I've given a couple of MCQs. I'll quickly have a recap for 5 minutes of previous session, and then I'll touch upon the MCQs, what I have shared in the along with the PPT. Hope you're able to see my PDF document. Students, you are able to see my PDF document. Please visit the Board of Studies website. There you have capsule-wise various contents put in, where you have previous questions, that is your RTPs, MCQs, chapter-wise your material, then recap material summarized in a pictorial format for your examination. This particular PDF, what I'm showing you, this is picked up from the Board of Studies website. I would recommend all of you download these PDF files and 1 hour before exam, just glance through these PDF. That is good enough for your coverage. Mansa, I'll quickly run through this PDF, then I'll come back to your questions. Right? Now, first we have started in our previous session with respect to the definition called assessment. What is the meaning of assessment? What all details are covered in this process of assessment, and how we will find out the reference to the first schedule, second schedule of Customs Tariff Act. In the process of that, we touched upon something called your section 12, which talks about your charging section. This segment, when you put into warehouse, the day when you file your bill of entry for home consumption from warehouse, that will be the point where my event, that is levy, gets attracted for collection of duty. In relation to exports, when the goods cross territorial waters, that's a point in time the collection of taxes do happen. Then from there, we will look into this first schedule, second schedule. My Customs Tariff Act has got first schedule, which deals with import related rates. Second schedule, which deals with your exports on the goods. What is the export duty applicable? Then we had discussion on section 15. We had a discussion on section 15. With respect to section 15, let me just pick my pen. Yes. So with respect to section 15, we have discussed how to identify the date relevant when we have goods cleared the customs or filing a bill of entry or goods taken into your warehouse. First point, in case of your home consumption, point number one, in case of goods which have come for home consumption, either filing bill of entry or date of entry inwards of the vessel or aircraft, whichever is later. Now I have given two examples where the bill of entry has been filed after the goods have reached the customs station. Second scenario where goods have reached bill of entry filed earlier to that. In both the cases, whichever is earlier, that shall be the date relevant for calculation of duty. In case goods are taken to warehouse, in those cases, when I file my bill of entry, that is a point in time when my date is to be referred for calculation of duty. The rate of duty prevailing on the date I file my bill of entry, that is relevant. Third case, now they say my date relevant will be date of payment of duty. This I have given example of derelict, flotsam or jetsam, goods which have been jetsam, where it has continued to float and reach the customs borders. That's the point where whenever I pay the duty, that is a date relevant for me. Moving further. Now, I have talked about some important reference to goods which have been exported and re-imported. There's a reference to one notification called 45 of 2017. 45 of 2017. So this notification, I have said that if my goods have been exported, maybe with LUT or maybe with payment of duty, or goods have been sent for repair purpose, in those cases, when I import back, there is a time limit within which the goods have to come back, where I have to pay concession rate of duty. So here I have said that in scenario number one, whenever goods have been exported, maybe under LUT or with payment of IGST, or cases where goods have been exported after enjoying some foreign trade policy benefits like advance authorization or EPCG. In those cases, they say that whatever incentive you have paid at the time of export, that shall be the import duty which needs to be paid. They say that don't pay customs duty again on the import. You just pay the benefit of incentive which you have taken. Most of these cases, we have something called duty drawback. I say duty drawback. So whatever duty drawback or incentive you have taken, please pay back that particular duty. That is good enough for imports. In case of goods which have been sent for repair purpose, that is your point number two, where my goods which are imported, I wanted to send it for repair. It has been done repair in the overseas and it is coming back. They say that my value for customs duty shall be fair cost of repairs, including cost of material, actually incurred or not. That means whether or not you paid money, what is the cost of repair? That is relevant. And second point is insurance and trade, also both ways. These two components, I'll pay my customs duty. Now, why I have to pay? Because there is a value addition happening, the goods which have traveled abroad, which were repaid and which has come back. So these cases, value of repair, value of material, and your insurance and trade, both the ways I have to take into consideration. This is in case of my goods sent under notification 45 of 2017. There are few conditions. The goods should have been come back within 3 years. Then the ownership should not change. Those are the few conditions which they have given. Next, you have one more notification called 158. We have discussed one notification, 158 of 1995. Under this notification, where I could have received the goods where I'm a manufacturer, my goods have been sent abroad for repair. These goods, when it have come back, should I need to pay customs duty? Now, question here comes is, why the goods have come? So goods have come for repair purpose because I gave warranty, or goods have come for reprocessing. So in either of the cases, they say that if the time limit for repair is within 3 years, no need to pay customs duty. If the time limit is 1 year in case of reprocessing or refining, then no need to pay any customs duty. And they have given a condition that after whatever activity you do, within a period of 6 months, please export this material back off to outside India. These are the conditions for 158 of 95. From there, I have discussed on 3 more provisions called Section 13, Section 23, Section 22. These 3 sections I have discussed with respect to pilferage. I'll come to my presentation to make you a little more ease of understanding. In the previous class, I have explained you provisions of Section 12, which deals with your charge of duty. Whenever we talk about this, I have recommended you, please keep in mind 3 another provisions. I gave example of Sita, Lakshmana, and Hanuman. Whenever we remember Lord Rama, we need to remember these 3 people. Now, Sita, why Section 13? There is a pilferage. There is a pilferage. Theft. I would call this as a petty theft. If you recollect this Ramayana, there is a place called Panchavati, from where Ravan takes away Sita from this place called Panchavati. So pilferage refers to small petty theft, where it is pretty visible that it's a cotton where you have multiple holders where you can store the material. So in case of pilferage, when the goods are lost after unloading, but before filing the doing the provisional order for release of the goods, then no need to pay any duty. Then I spoke about Section 22, which talks about your damage. Now, when we talk about damage, you can remember Lord Lakshmana, when there was a war which happens, Lakshmana loses his consciousness, where this Lord Hanuman brings this booty for making him back to life, where a petty damage happened. I would say the damage where Lakshmana collapses is in the process of fighting. Where in case of damage, we have discussed that the duty needs to be paid on abatement basis. On abatement basis. That means to say, whatever repair is there, to the extent of repair, there is a loss of value. Loss of value. So your customs duty, whatever original customs duty is there, you will reduce your customs duty proportionately and you will pay lesser duty. In case of Section 23, I was referring this as goods which have been lost or damaged. Like Lord Hanuman, when he visits Lanka, he puts fire to Lanka, where he destroyed entire Lanka, which is beyond recovery. So this is how you correlate your provisions and mythological, just to recollect in your examination. So in case of goods which have been lost or damaged, the importer has to prove to the satisfaction of AC or DC. For what? For getting remission from payment of duty. For getting remission from payment of duty. In case of Section 23, I will seek for remission. That means I will not pay any duty because goods have been lost or damaged. Now, when damage, I also call this as destroyed. Goods are destroyed. Damage generally, please Damage is the right term to use under section 22. For section 23, destroyed is the right term we have to refer. Why destroyed? Goods are not possible for recovery. Now, these are the provisions what we have discussed. In addition to this, we all also have discussed on provisions in connection to section 25. Section 25. Section 25, which dealt with your exemption notifications, where I have made you understand what is a general exemption notification and what is a special order for permitting someone to get an exemption from payment of duty. And I also made you understand something important with respect to insertion of explanation. When an explanation is inserted with reference to a notification, how the date has to be counted with respect to referring to that particular exemption. Now, what I will do, I'll quickly run through the MCQs, what I have shared to you. I'll give you answers and then we'll come to today's discussion. Please open your Word document. I've shared the Word document in the last session. This Word documents will help you to assess your knowledge with respect to the previous class. First question. For computing the value of re-importation of goods sent for repairs or abroad, following expenses are relevant. So here they are referring to value for re-importation of goods sent for repair. Goods sent for repair. So what is happening here? I, as an importer, I'm getting back my own goods after repair, which were repaired overseas. Here, value of material used in the repairs done abroad. Now, whatever repair was done, my value of repairs has to be considered for payment of customs duty. So answer point number 1 is relevant. Point number 2, freight and insurance from abroad to India. So this point is saying that whatever insurance and freight are paid from overseas to India alone has to be taken into consideration. This is incorrect. Reason, I have to take both the sides. I have to take freight and insurance both the sides. Point number 3, fair cost of repairs incurred but not paid. Now here, point number 1, they are referring to value of material used in a repair. In point number 3, they are referring to repairs cost along with the material. So point number 1 is relevant. Point number 3 is also relevant for me. Point number 3 is also relevant for me. Then point number 4. Point number 4 says insurance and freight paid both the ways. Insurance and freight paid both the ways. This is also relevant for me. So 1, 3, 4. These 3 points are relevant for me to come to a conclusion. So answer for this will be 1, 3, 4. That is point number C. Moving, second question. Goods re-imported which are manufactured in India for repairs would be allowed for import without payment of duty shall be permitted if the goods are imported within 3 years of export, within 2 years of export, within 1 year of export. Now, this is a point with reference to notification 158, where my own goods which have been sold, if those goods are coming back for repair, please look at the term repair. Now, if it is a reprocessing, a reconditioning, or refining, then it is 1 year. So, in case of repairs, the answer will be 3 years. And for Nepal and Bhutan, answer will be 10 years. For question number 2, answer is point number A. Then let's move on to question number 3. Duty on pilferage, duty on pilfered goods is applicable if. So they're asking, when should I pay the duty on pilfered goods? So option A, goods are lost post clearance from customs station. Now, once I clear the goods from customs station, that means I've taken into my possession. So if the goods are lost in my custody, there is nothing called pilferage. So here I have already paid the duty. The goods have come into my possession. Once the goods are lost, after clearance from customs station, there is nothing called pilferage. Then point number B. Goods are stolen post unloading, made good to the importer at the time of clearance. Now, this is a case where they are saying that after unloading, the goods have been lost. But before clearing for home consumption, the goods were given back to the importer. Now, this is a point very, very important. Pilferage, I have to prove, there should be visibility that goods have been stolen. Now here, before I could clear the goods for home consumption, whatever pilferage happened, my customs officer, someone has made good those pilfered goods. So in this case, I have to pay my customs duty. So point number A is irrelevant. Point number B is relevant. Point number C. Goods are pilfered after the insurance surveyor examination. Now, this is a case where this survey is being done by insurance surveyor for the purpose of assessment of duty. At the time of assessment, if the goods are available, then I have to pay customs duty. I have to pay my customs duty. So here, this is the relevant point. And this, because goods are available, I'll be paying customs duty. I will say this is irrelevant. Answer for this will be point number B. Point number 4. Question number 4. Goods which have reached Indian customs water on account of derelict jetsam, flotsam. Please keep in mind, though this have come on its own, it will be treated at par with goods imported into India. So answer for that will be treated as if such goods have been imported into India. Answer is yes. I have to consider it par with goods imported into India. Question point B. No duty shall be imposed on such goods because no person is identified for such import. Answer here. It is not important for me to identify importer. Whatever goods have come into customs station, the duty is payable. Partially dutiable, partially exempted. There is nothing called partially dutiable, partially exempted. Because B and C fail, answer is going to be A. Then question number 5. Examine the provisions for pilferage and remission with respect to applicability of duty. So they're asking what is the correct statement with respect to pilferage and remission. Please keep in mind, pilferage, I don't have a burden. Remission, the importer has the onus to prove to the satisfaction of AC or DC. Question point 8. Onus to provide in case of pilferage. Pilferage is not on importer. So this is incorrect. Point number B. Remission is permissible only when concerned AC/DC satisfied for pilferage of goods. Again, this is an incorrect statement because remission I use only for section 23 called goods lost or destroyed. This is also incorrect. Point number C. Onus to prove petty theft, etc. is not in case of pilferage. Correct. However, in case of goods lost or destroyed, importer has to prove the satisfaction of AC/DC. This is a right statement. Clause D. There is no onus to establish in case of pilferage of goods are lost or destroyed. Pilferage, lost, destroyed. All the cases they say that there is no onus to establish. Again, this is also incorrect statement. Because C is the only correct statement, answer would be C. Last question. Explanation provided in an exemption notification shall be inserted within 2 years of such notification. Please remember, whenever explanation is inserted, it will always be within 1 year of that particular notification. So this is incorrect. Clause B. Issued within 1 year of such notification to be effective from the date of such explanation. Now, this statement is incorrect. Whenever explanation is inserted, the explanation have its validity. It will be inserted 1 year from the date of the original notification, not from the date of inserting the explanation. So this is incorrect. Clause C. Issued within 1 year of such notification to be effective from the date of such exemption notification. This is the relevant answer. So answer for question number 6 is clause C. Now let me come back to my today's presentation. Mansa, hope you have got answer to your questions. I'll reconfirm once again. Your first question, let me just look at your questions. First question, you are referred to notification 45 of 2017, where is it applicable on LUT or bond without payment of IGST only? Answer is yes. It is applicable for LUT or bond where goods have been exported. After the goods have been exported, when the goods are coming back, I can apply notification 45 of 2017 for getting a concessional duty. And your second continuation, you say Is it applicable on exports for repair abroad also? Answer is a perfect yes. Where once the goods come back, I pay customs duty only on the value of repairs, material, freight and insurance, both the ways. So first for your question number 1, answer is affirmative. Next question, Mansa, you're asking with respect to what do you mean by social welfare surcharge? Today's class, I'll make you understand what is the meaning of social welfare surcharge. Then Purushottam is asking this question. Purushottam says, so particulars specified in schedule number 2, items are supply of goods and services irrespective of section 7.1. Answer. Now Purushottam is asking this question. So when we refer to schedule number 2, there is an entry for classification of items as supply of goods or supply of services. Will that be a supply irrespective of section 7 subsection 1? Answer, Purushottam. Only when there is a supply as per section 7, then you will travel to schedule number 2 to identify whether that is a supply of goods or supply of services. Example, sir, I have rendered this particular canteen services. I supplied food to, say, defense or some ISRO. So will that be supply of goods? Will that be supply of services? Answer will be, first you check your section 7. Was there a supply? Now, for something to be called as a supply, you should satisfy all the requirements of section 7. For a moment, let's assume that there is this World Defense Day, like some auspicious day, you have contributed some meals to the defense or army people. Now, there is no consideration. It is given free of cost. When there is no consideration, my supply will fail. When supply is failed under section 7, I need not travel to schedule number 2 to see whether it's a goods or services. So answer, Purushottam, only when supply is satisfied, then you will visit to schedule number 2. Next, Purushottam is asking this question. Under pilferage, it is due to any cause. For example, sugar was kept at warehouse, rats were consumed some portion of it. Is it also covered under pilferage? Now, pilferage, there should be a petty theft which should be made visible to the offices. Now, if small amounts of theft happen, yes, this can also be called as a pilferage. I partially agree with your point, Purushottam. Yes, Purushottam. Purushottam is asking this question. Sir, in relation to liquidated damages, is that a supply compensation on account of termination clause or the actionable claims? Now, please remember, Purushottam, if this actionable claims is part of a contract, it is not the main essence of a supply. Like, I'll give an example. I put a contract with my supplier saying that if you delay in supplying the goods within 2 weeks from the date of my purchase order, I will levy a liquidated damages of 10%. Now here, when I say liquidated damages, this is a contractual obligation, not anything to do with the supply. So my supplier supplies the goods, I buy the goods and I make the payment. Any money required by way of liquidated damages cannot be considered as a supply. There was one circular issued by the CBIC, Circular 173. If you refer to that, you will get more clarity. Purushottam. Yeah. Now let's start with our today's discussion. Students, before I start with today's discussion, let me give you the backdrop, what you need to understand, what is important from examination, and how do you need to look at learning from this particular chapter. All of us know that clearing this chartered accountancy course is tough. Now, the way the clearing professional examination is tough, the provisions connected with today's discussion are more to do with the provisions of Customs Tariff Act. Please note, most of my references are from Customs Tariff Act. Please have in your mind, whenever I refer Customs Tariff Act, let me just come to a web screen. Whenever I refer to Customs Act whenever I refer to Customs Tariff Act, please understand Customs Act is more connected with procedural aspects. Session 1, when we talked about levy, that section 12, then the other provisions, section 13, section 22, section 23, exemption, all these are procedural. When I talk about Customs Tariff Act, this predominantly refers to reference to rate of duty. It predominantly refers to rate of duty. Rate of duty could be for exports, could be for imports. So you need to keep in mind, whenever I refer to this Customs Tariff Act 1975, this is referring to rate of duty. Whenever I refer to Customs Act 1962, it refers to procedural aspects. This is how you need to understand. Now, this topic of today's discussion, examination, you may have theory questions where what do you mean by safeguard duty? What do you mean by anti-dumping duty? What do you mean by protective duty? So they will ask theoretical questions connected with today's topic, where examination you are going to have theory asked for 3 marks. Now, in addition to your examination, I also put it this way. If someone is really interested to do research, to get an expertise on a particular subject matter, today's topic is going to be one of such important topic where you'll understand how practically the departmental officers are going to understand the economic activities of a nation. Based on the economic activities, how a decision is taken to protect the economy of India. Like example, if you would have seen what is happening in Sri Lanka, what is happening in Pakistan, and also what is happening in US because of this recession, which is hit badly because of the activities of war which took place between Russia and Ukraine. There was a severe power crisis because of the fuel, and because of the fuel, inflation is at peaks in US. They haven't seen the interest rates so high in the last 15 years, and that caused to a lot of job cuts and price hike everywhere. Now, these are a couple of examples where the Ministry of Finance, the Ministry of Commerce, I refer to two ministries. One is Ministry of Finance, Ministry of Commerce, where some of you who are listening to me, post your qualification, if you happen to get into civil services, maybe IAS or IPS, administrative, if you happen to get into the revenue, the other side is Indian Revenue Services. If you happen to get into revenue services and you join this economic affairs or this ministry, you will be part of this research tank. I use a term called research tank, where a lot of thought process goes on, to understand how the economy is performing, what goods are coming into India by way of import, what goods are going out of India by way of exports. Is there any threat? By way of these two activities to the India economy as such? Now, these aspects are the backbone in today's topics, where I touch upon something called types of duties. That means why this duty was brought in, what made the officers or the government to think that this duty has to be brought in, what is a pinching factor for a businessman in India, what is the pinching factor for the domestic business, how the domestic market should be protected from the overseas market. So these are all the discussions which we are going to have in today's session. It is completely technical. I'll make it more practical and with more examples so that you can understand. Please wait in this entire 3 hours what I'm going to talk to you. Look at this as a learning, how you can use your knowledge for your future career purpose. Now, Customs Act 1962, as I said, this is my procedural law. So whenever goods have been imported, whenever goods have been exported, then I refer to section 12, which deals with your charge levy. So whenever a levy gets triggered under section 12, then I refer to section 2 of my Customs Tariff Act. I refer to section 2 of my customs tariff. For what? For identifying what is my rate of duty. Clear? So first, whenever someone comes to you for an opinion, someone comes with a transaction, what is that you have to do? Examine whether there is a levy under section 12. We have discussed section 12, charging section, right? Once I know that there is a duty which needs to be paid, then what I have to do? Look at schedule number 1 in case of import of goods. In case of imports, look at your first schedule. Sir, if I'm exporting goods, then in case of your export transactions, look at your schedule number 2 of your customs tariff. So this is how your code, your identification happens. When I'm importing, please look at the headings, chapter wise, which is given in first schedule. Based on your HSN, look at your second schedule for exports. This is the way how you start with your identification of the levy and then respective rate of duty. Now, relevance of HSN, though most of us know HSN stands for Harmonized System of Nomenclature. This HSN is a standard which has been set by World Trade Organization. World Trade Organization to abide with international trade policies. International trade policy. So any HSN we refer as on today in India, we have adopted the guidelines which are issued by World Trade Organization. India has adopted this HSN as per the World Customs Organization. World Trade Organization, World Customs Organization, both refer to the same entity. So as on today, all the nations which are part of this WTO agreement, they have to adopt the HSN nomenclature, which is recommended by this WTO. And this HSN is a nomenclature. It's a standard. I can call this as a standard code. Standard code. Now, so why we refer in HSN? How does it help? Or if you ask these questions, now if I show you a water bottle, it's a say water bottle can be made of plastic, can be made of copper, can be made of any other metal body. Water bottle is a nomenclature in English description which is known in India. If I have to travel to abroad, I may not call this as a water bottle. I may call something else. Now the description, the language, one nation to another nation changes. This particular nomenclature is exchanged by way of a reference called HSN. In India, we use 8-digit level HSN. In standard, there is a 6-digit as per WTO. Now, if you refer to this first schedule or second schedule, this is how your first schedule or second schedule looks like, where you have a tariff item, that is the HSN. You will have your HSN. The 6-digit or 8-digit, you will be having the HSN. Say 3501, under that, say 01, maybe under that 08. Now, this is called heading, this is called subheading, this is called heading, subheading. For this HSN, I have description. This is a nomenclature which we generally use in our nation. And this is a trade parlance theory. That means the goods what we are referring, what is the unit of measurement? Do I measure in kg? Do I measure in liter? What is the unit I refer to? Then I have something called standard, which is called as your customs rate. Customs rate. In column number 5, you have preferential area rate. Preferential area rate. Now, preferential area rate, there is one slide. I'll come to this preferential area rate in a couple of minutes. So as of now, please keep in mind, whenever we refer to any HSN, any rate notification, this is how my headings look. Heading 1, 2, 3, 4, 5. This is what we need to look into your tariff notification. Now, preferential rate of duty. I was in table number 5. You can see the last column, preferential area, right? So this preferential area, this preferential rate of duty is generally it's a standard rate of basic customs duty. And if goods are imported from areas which are notified by the central government to be preferential area, then lower rate of basic customs duty is applicable. Lower rate of basic customs duty is applicable. That means to say, now if you look at this heading, you have entry number 4, entry number 5. Say entry number 4, if you look at a notification, for a moment, in serial number 4, I have 12% as a rate. Similarly, under table number 5, I have say 5%. So this is your regular duty, regular rate of duty. But for some of the nations, I call that as a preferential duty. That means this preferential will prevail over regular duty. So now there will be some countries like say Japan, Taiwan, or some of the countries where the government of India says that for the goods which are imported from these countries or goods exported, this is my preferential rate. So whenever I have a rate 12%, 5%, entry is there in 4, entry is there in 5. Based on the country which the government has notified, the lower, that is the preferential rate, is applicable. Now, importer has to make a specific reference. So whenever there is a preferential rate I have to choose in my bill of entry, or my shipping bill, I have to mention that I'm choosing this preferential rate of duty. Unless you choose this, you will not get the benefit of that particular notification. So goods manufactured or produced in such preferential area, origin of goods shall be determined in accordance with the rules made thereunder. So as on today, only in relation to my imports, I have this preferential rate of duty. I have to pay my preferential rate of duty on the basis of the origin. Goods determined in accordance with the rules where the goods are produced or manufactured in a particular country. So if you want to understand, as on today, way back in 1982, the government of India has identified that any goods which are manufactured in Mauritius or Seychelles or Tonga, now these are the nations' name. These nations, any goods which have come into India, I can choose something called preferential rate of duty. So here, step one, you will refer to schedule number 1. Step 2, in schedule number 1, that is in relation to imports, look at serial number 4, serial number 5. Step 3, if entry found for both serial number 4 and serial number 5, then step 4, look at the nation or origin. What we will do, in case if the goods are imported from any of these countries, then my step 3, I'll go for a rate available as per serial number 5. I'll go to rate available as per serial number 5. This is how my preferential rate of duty has to be understood. Hope this is clear, students. Now, why is that government has given this preferential rate of duty? They have given this preferential rate of duty to encourage a particular country, the goods to be imported into India. Purushottam is asking, sir, what to do immediately after getting into qualification? Purushottam, I would suggest choose one area, like you have income tax, you have insolvency profession, you have derivatives, you have insurance, you have direct tax, indirect tax. You have multiple areas. If you want to choose indirect taxation, I would recommend start taking up work with respect to GST audit, with respect to customs provisions. Customs, as I said earlier, there are very, very few people available who are practicing on customs. So start taking up that work so that you'll get more comfort on your practice. And Mansa is asking, if I want to explore this part of learning as well as clearing exam, which platform you will recommend? cbac.gov.in is for the sections and rules related Mansa. And if you can afford to buy any subscription, the economical one, you can plan for at times this Tax Management India. Tax India Online is it is little costly, but Tax Management India is there. You can subscribe where you will get the list of notifications, case laws, and connected provisions. Purushottam is asking, what is the difference between tariff rate and rate of duty? Tariff rate is nothing but the rate given for a particular tariff item. I come to my slide once again. Now, tariff rate is a rate given. Probably there's one slide, Purushottam. Once I come to the respective slide, I'll give you exact clarity with respect to tariff rate. Generally, it refers to the rate predetermined, saying that for these set of goods, this is the rate. And rate of duty, whenever tariff rate is given, rate of duty will not be given. So there are a few items where they wanted to prefix. This is the value on which this is the duty you are going to pay, right? That's a reference to tariff rate. Moving on from there, levy of additional duty under Section 3. Levy of additional duty under Section 3. Please keep in mind, we are in 2023. This Customs Act has been formulated in 1962. Customs Tariff Act has been formulated in year 1975. Now, the good thing is, this Customs Act or Customs Tariff Act was not amended very frequently, but suitable changes were made under Section 3. The suitable changes are made under Section 3 to match to the requirements of your tax laws in India. So when we talk about this, why we are talking about 1960 to 1975? Most of us were, none of us were born in that point in time. Now, answer is, the customs, like if you recollect the example what I gave in the last class, when I want to buy a car, I have a choice to buy in India. I have a choice to import the car where I can save the duty. Now, to make a level playing field, there is something called duty, customs duty. Along with that, tax and cess was brought into picture. Now, that's how this additional duty comes into picture under Section 3, where they say, any goods imported into India, liability of excise duty for time being leviable on like article if produced or manufactured in India. Now, what they have said, at that point in time, we had central excise. That's why they say, if at all, if goods are manufactured or produced in India, whatever excise is payable, similar duty I levy called additional duty. Along with customs duty, I collect some additional duty called additional duty. Why this additional duty? To compensate the excise duty payable. So duty imposed to compensate such excess is called additional duty. This additional duty is to take care the rate or mechanism adopted similar to central excise. Post GST, now we are talking about GST. 2017, all of us have moved from central excise, sales tax, service tax, VAT to the GST era. So here, when we talk about customs law, we need to keep in mind that my GST provisions have to be brought into my customs provisions. That's how this additional duty was, that Section 3 has been completely revamped to take care of your GST plus compensation cess. So keep in mind, my basic skeleton of Customs Act, my basic skeleton of Customs Tariff Act, both were kept intact. Similar provisions with respect to alcoholic liquor. Now, I spoke about central excise. Now I'm talking about additional duty in relation to alcoholic liquor. Now, this alcoholic liquor, when I import into India, Now, please keep in mind, the other day I have referred to list 1, list 2, list 3. This alcoholic liquor is a state levy. So, this customs provision says that whenever alcoholic liquor for human consumption is subjected to excise, the central government, by way of a notification, they adopt a rate of additional duty, whatever is the rate prevalent in the state where excise duty is charged. So whatever customs duty you generally pay, in addition to customs duty, you pay something called additional duty to compensate this duty levied by the state. So why are we levying this? To make a level playing field for imports to match the price, whatever gap is there in the pricing, that has to be matched. Now, I was referring, please always remember, whenever you read these particular concepts, you have to get into a research mode. Means you have to think. You have to think from economy point of view. If there is a loophole in a system, how the loophole is being fitted or the gap is being filled. So in case of state liquor, whatever state excise duty is there, that is going to be considered as a additional duty. Now, the analogy for this additional duty under section 3, I call this as countervailing duty. CVD. CVD. CVD stands for countervailing duty. Countervailing duty. Now, this countervailing duty is a duty which I levy whether or not the additional duty is applicable. Now, additional duty, I was referring to central excise. I was referring to state excise, right? Similarly, this is that in India, suppose there are a few raw material components, etc., which are manufactured. Like again, this is a provision prior to GST. If the goods are manufactured in India, if excise duty is applicable, whether or not those goods are subjected to customs duty, I wanted to levy something called countervailing duty. So this countervailing duty is to match the excise duty paid by domestic manufacturers. As on today, this is irrelevant. This is past. Just prior to GST, this would be relevant for your exam. Post GST, maybe for petroleum products, this is relevant because your petrol and diesel, this is still subjected to central excise, not subjected to GST. Only petroleum products, this countervailing duty is relevant. Similar to countervailing duty, there is something called special additional duty. Special additional duty. This special additional duty is relevant to compensate sales tax, VAT, or local tax upon entry. Now, again, this SAD under section 3, subsection 5, till 2017 July, this is relevant. From 1st July 2017, this made null and void. So again, this is there under section 3. In your syllabus, they just touch and they vanish from this discussion. Now, important aspect under GST era. Under GST era, they say that, look, whenever the goods are imported into India, the goods will be subjected to additional duty, which is called IGST under section 3, subsection 7. Section 3, subsection 7. So what they say, whenever I pay customs duty, in addition to that, I pay something called IGST. I pay something called IGST. So why are we forced to pay IGST? Please remember your assessment definition: duties plus taxes. Duties plus taxes. So here, the policy, the lawmaker is thinking that whatever the tax you're paying within India, let me replicate that along with my customs duty. A simple example, take example of your landline. All of you, if you have this landline, the landline box, the particular telephone, what we call this particular telephone, if I don't levy this IGST, it's going to be a unparalleled or uncomparable field for the domestic market who are manufacturing this particular telephones and the importer who's importing directly from China. There's one of the government entity called ITL Limited. ITL Limited is one of the prominent company in South India who manufactures this landlines. So in year 1980, when these imports happened, this was the thought process where they say, if I manufacture in India and if you permit the importer not to pay the duty which is being suffered in India, not to pay the taxes which is suffered in India. Now, earlier, prior to GST, I used to pay something called CVD. I also used to pay something called SAD along with my customs duty. This is the time till June 2017. Post 30th June, from 1st July, along with customs duty, I'm just paying something called additional duty, which is under section 3, subsection 7. This is to compensate your GST. This is from 1st July 2017. So to start with, they say that levy of IGST is there, where my maximum rate of tax is 40%, which is capped under section 9 or section 5 of IGST Act. And they're saying, refer to this notification 1 of 2017 for the rates for a particular item. And if there is an exemption, please refer to notification 2 of 2017, integrated tax. This is the basic backbone, the cardinal principle, where they say, along with customs duty, please levy something called additional duty. So first and foremost, as on today, whenever the goods come into customs area, I pay along with customs duty, IGST under 3, subsection 7. Mechanism to calculate. Now, this particular slide, how we calculate, tax upon tax, duty upon duty. Examination, you're going to have one question for 6 marks. The next class, I'm going to touch upon valuation and how these duties are computed. So today's session, it's completely theoretical, where I make you understand the background of the duties. So how do I calculate, on assessable value, how I calculate customs duty, how I calculate this additional duty, all this computation mechanism. In the next session, I'll take you in detail as a practical. So probably problems, don't worry in today's class. Next class, I'll make you to work out on few problems. This mechanism, they say that for the purpose of collecting tax, aggregate value of imported goods as determined under section 14. This section 14 deals with your valuation. Next class is going to be more interesting, very interesting for the reason we'll touch upon the problems. Examination, damn sure there is going to be a 6 marks question in your final examination. So for that reason, your next class is going to be very important. I'll explain how we calculate the value under section 14. Once I derive value, how my duty is assessed under section 14, and on that, how do I calculate my customs duty? Now, there is a reference to something called tariff value, fixed under section 14, subsection 2. Tariff value fixed under section 14, subsection 2. Okay. Now, central government has to fix the duty. I don't know how many of you have seen this bullion market, gold, silver, then steel. This gold, silver, steel, all rates do fluctuate on a daily basis. Why is that? Because government fixes the tariff value. Government fixes the tariff value. Now, this is a decision made by central government. They say that irrespective of your transaction value, for few commodities, the tariff value is prescribed. My tariff value is prescribed. That means I don't pay duty. Now, whenever I talk about duty, I can pay duty on transaction value, or I'll pay duty on tariff value. Tariff value. What do you mean by transaction value? Transaction value, I refer to section 14, where what is the value of goods I have paid, what additions I have to do, what deductions I have to do. That is the importance of my transaction value. What is a tariff value? Tariff value is a value which is fixed by central government. This is fixed by central government. So when there is a goods which are notified under 14 subsection 2, you have to pay customs duty as per that value. Now I'll give you an example. This is one of the table. I've picked only few items. The goods, if you can see here, chapter number 15, chapter number 74. Your palm oil, then palm oil in a different fashion. Crude palm oil or RBD palm oil, crude soya bean oil or brass scrap. Scrap which is in relation to alloy metals. So in case of these metals, what they have said, this is going to be your tariff value. Means pay the duty on this value. Pay the duty on this value. Like in case of this, they say per metric ton, this is going to be your 989 is going to be the dollar value. On that day, whatever conversion rate is there, I convert into INR. Whatever rate is there, that will be my payment of duty. So here, classic example is gold, silver, metal, and oil. Now, these are some of the goods where section 14, subsection 2, the central government has shown, decides how you have to derive the tariff value. Hope this is clear, students. When I refer to my payment of duty, my payment of duty can be done under 14, where I may refer to transaction value, I may refer to tariff value. Sir, how do I know for which goods the tariff value is fixed? Now there is a notifications. Now, like first and foremost, you not get to know everything on day one. You have to read daily notifications which are being issued with the CBSE customs. Once in a month, they give you conversion rate. I don't know how many of you have done with valuation. I'll quickly explain this relevance of customs notifications. When we talk about your inventory valuation, especially in relation to imports, that is goods, the rate fixed by customs on monthly basis. Now, this is a rate adopted for your translation of Forex. Now, most of the companies, when you look at your inventory valuation, you refer to your notes to accounts. In notes to accounts, you give what is the value of goods you have imported into India. Now, this conversion is adopted on the basis of my customs notification, where every month for all the foreign currency, they will give you the translation rate. In relation to services, now inventory valuation is not relevant here. I'll refer rule 34, where it talks about your Forex for conversion. So here, for services, the value as per generally accepted accounting principles. Services, they don't say you go as per RBI rate or you adopt as per your authorized dealer rate. They just say that whatever is the rate generally accepted for your accounting, that is the rate prevalent. Yeah. So here, when we talk about this inventory valuation, the way we have various notifications issued on daily basis for section 14, subsection 2 for metals, base metals. So only for these base metals, always we don't refer to transaction value. Rather, we refer to the section 14 subsection. That is your tariff value. Let me see if there are any questions so far. Purushottam is asking to get into Ministry of Finance or Commerce, what we have to do. Give your Indian Revenue Services, clear your IRS, and then you can become AC or DC. From there, based on your performance, you can get inducted by Ministry of Commerce or Ministry of Finance. Is it necessary to know by the supplier whether the recipient is a final consumer or not? In case the recipient is not registered, to furnish B2B or B2C supplies in my 3B. At the time of issuing your tax invoice, Purushottam, you need to know whom you're going to supply. If you're going to supply to a registered person, GST, like refer to Rule 46 requirement, where the GST number of the recipient is mandatory. Mansa is asking this question. Only central government earns income through customs. It shares with CGST. Yes, Mansa. In relation to goods which are imported, please keep in mind, IGST is collected by the central government, where both central and state rates are there. Consumption based, where the state where the consumption is going to happen, there the respective states are going to get the balance 50%. Collection point, IGST goes to the Union of India. From there, the allocation happens to the respective states. A very, very technical and valid point, Mansa. And you remember, so how do we get to know that the respective states should get that 50% based on your IEC? When you have IEC, you will have your GST number. Once you have GST number based on your state code, say 27 Maharashtra or 7 your Gurugram or 7 Delhi, 6 Gurugram Haryana, then 33 Tamil Nadu. Based on your state code, when you give the GST number, your IEC will have the as attachment of GST number. On the basis of that, whatever IGST is paid, 50% goes to the state central government, 50% comes to the state government. Then Purushottam is asking this question. GST rate is determined based on the considering all aspects like manufacturing, services, GST rate additional on manufacturer, how it will be encountering manufacturers, is my view correct? This is a common levy of additional duty, that is GST compensation cess. This GST compensation cess, like your IGST, 3 subsection 7, this is levied under section 3 subsection 9, and manner of computation 3 subsection 10. Next class, I'll explain the method of allocation. This compensation cess is applicable as on today on soft drinks, tobacco products, and motor vehicles having a separate specified engine capacity. Now, rate of cess is ranging 12 to 18%. So based on this compensation cess, I will be paying customs duty, I'll be paying IGST, I will be paying IGST cess also, or I will say compensation cess. I'll just say compensation cess. This is levied under section 3, subsection 9. As of today, only 3 products are identified for your compensation cess. Now, section 3, subsection 8A refers to your warehouse. Now, warehouse is a concept where I have a option 1 to take it for home consumption or take the goods to warehouse. Now, when the goods are in warehouse, option 1, I can do a trading activity. That means to say, I store the goods in a warehouse, sell the goods to a customer whenever the customer is available to buy the goods. That means, say for a moment, Kaushiki has imported the material. Kaushiki has kept it for 3 months. She found a customer called Mansa. So Mansa, like Kaushiki, can transfer the title, the goods to Mansa, where Mansa files the bill of entry to clear it for home consumption. At this point in time, they say, my IGST will be value as per section 8 or transaction value. Transaction value, whatever is the value I pay, that is Mansa, what Mansa pays to Kaushiki, that is going to be my transaction value. Option number 2, sir, I don't do the trading activity. Rather, I do a manufacture. Means I may do a assembly activity, which tantamount to say manufacture. When I do a manufacture, there is going to be a value addition. So here they say, please refer to your section 8, where your cost of goods imported plus value addition which is done in the warehouse. That can be taken as your transaction value. Point number 3, I can export the goods right away from warehouse as it is. So in these 3 cases, only when 1 and 2, when the goods are cleared for home consumption. When the goods are cleared for home consumption, they say whatever transaction value is there, that is what Mansa is paying to Kaushiki. For a moment, say Kaushiki has to pay 15,000 US dollar for a particular commodity which is imported. She has kept the goods in a warehouse for 3 months. After 3 months, Kaushiki is selling the goods to Mansa, say with a value addition of 3,000 for 18,000 USD. When 18,000 is the money paid by Mansa, when Mansa is going to file her bill of entry, customs officer says, I will not take 15,000 for the duty purpose. What was the last transaction value? Because Mansa got the title by paying 18,000 to Kaushiki, this 18,000 will be the value relevant for computation of my customs duty. This is the value which I take for section 3, subsection 8A. Now, whenever I talk about warehouse, please remember under GST law, as per schedule number 3, entry number 8A, till the goods cleared from warehouse, it is not considered to be as a supply. So in the previous example, goods sold by Kaushiki to Manasa, she will declare as a non-GST supply in her GST return. When Manasa is clearing the material, she will be paying customs duty, and the value what she has paid to Kaushiki on that customs duty is payable. So Kaushiki, when she gets that consideration of $18,000 into say 82 per dollar, that value Kaushiki is going to show as a non-GST supply because schedule number 3, entry number 8A. Now, from here, the key aspects of types of duty, whatever we have discussed now, students, it's all routine in general. From here, it will be more interesting to understand how this thought process is evolving to protect the Indian economy as such. So starting with protective duty under section 6, section 7. So here, the government may determine. Now there is a commission, there is a committee called Tariff Commission. Tariff Commission is a committee which is established in the year 1951. And what is the purpose of this committee? They will review, they will make a recommendation for what? To fix a tariff for a particular product or for a particular industry. I can fix the tariff for a particular product or I can fix the rate for a particular industry. What do they give indication? They give indication for revenue, collection of taxes, collection of duty. Now here, this tariff committee is a set of group of individuals where they will do a research and they give a recommendations to the government. What? For the purpose of revenue, either to increase or to decrease. Now, either to increase or decrease, they have to make a recommendation. So Minister of Finance comes and says, like what happens in a general company, I have to collect taxes or duties, my revenue, say by 10,000 crores. Let me know how do I collect my money. So this committee is going to make a recommendation where the government can earn revenue. Now, how do they do that? You have something called data from Ministry of Commerce, data from Exim, data from Ministry of Commerce, data from Exim. Now, most of us, like in your articleship days, you might not be dealt with the procedural aspects. I'll give a simple example how this data can be collected. Whenever I have to export goods, what I do is I take a declaration from a local commerce body saying that these goods are manufactured in India. So if I say this is a manufactured in India, I should get some certificate from a local commerce association. Like we have this FICCI, or we have this trade commerce industry. Every state have this trade commerce. They have an association. That association has a body which does a certification, something like STEP, something like your FICCA. So what I do as an exporter, I fill a particular form. I go to that particular ministry. I give the data saying that these goods manufactured in Maharashtra, I'm exporting to Europe. These goods which are manufactured in Germany, I'm going to import into India. So I'm going to give this declarations to export import authorities or to Ministry of Commerce. So this is my data bank. This is my data bank. Based on this data bank, this committee is going to give a advice. How and which particular, should I target a particular product? Should I target a particular industry? So when I say industry, rubber industry, your what you call agricultural produce, or cement construction industry, or you have your interiors electronic industry, various sectors. I can as a committee, they can look at the industry as a whole, or they can look at a particular product. So what do? They give a recommendation. Look at that revenue, like a recent budget, Finance Act 2023. The Honorable Finance Minister has said that on this solar panels, I'm increasing the rate of duty from 5% to 12%. Now, what they have done, they noticed that the solar panels are increasing for consumption day by day. So they felt that initially there was a lesser user acceptance. To get more user acceptance, they picked the customs duty at a very nominal rate called 5%. Once industry started consuming these items, they felt that now let's enhance from 5% to 12%, straight away jump of 7%. So where the ministry gets some percentage of increase in revenue. This is one recommendation they're going to do. Second, protective duty. Now, the committee is not just going to recommend increase the rate or decrease the rate. They're also going to make a recommendation to protect an industry or to protect a particular product. So why is that the production being done? There could be a glut of cheap imported material or articles in the market. When I say glut, now this, I see a flux of goods or commodities which are going to come into a particular nation. Now that is a point in time when this committee is going to say, let's take an action by way of a levy called imposing a duty called protective duty. So what happens here? The importer is going to pay customs duty plus protective duty. Why this protective duty is being imposed? Because there is a threat by way of cheap commodities which are coming into India. I'll give you one example where you can see this example. Like in the year 2016, there are three companies called Vedanta Limited who are into manufacturing of this aluminium. Bharat Aluminium Company Limited and Hindalco. These three companies, Vedanta, Bharat Aluminium, Hindalco, these three have written a letter to this committee. What they have said, we are into domestic manufacturers, where we are catering to 50% of domestic industry need. And they say that there is an import which is happening by way of unwrought aluminium, which is aluminium which is not alloyed, and aluminium alloys. I have both aluminium not alloyed and aluminium alloys. These commodities are coming into India, but they have also given a recommendation from China, a particular nation. These goods are coming into India. What is happening? It is coming at much lesser price, and which has completely destroyed our business. I recommend, if time permits, you can do the Google on this number called GSR 435E, dated 21st April 2016. One of the fantastic report where a committee of officers, now when I say committee of officers, they are the research scholars. Definitely one of them would be a chartered accountant like you, who is a part of this committee. What they have done, how the analysis has been done. So what they have done, they have taken the statistics of last 3 to 5 years. Like I given a reference to data bank. So they have analyzed what is the average price sold in India, what is the average price which is being imported from that particular nation. Now they also did a research how this particular commodity is killing the Indian economy. And this commodity, was it coming from one particular country or is it coming from multiple countries together? This is like a like when you talk about creating a war, it need not be a physical war which is happening between Ukraine and Russia. This can be created by way of attacking your economy. Now, for a simple example, when you look at your Indian borders, now you have your countries like Mauritius, Singapore, China. Then you have your Nepal, Bhutan, your Burma. Then few other nations. When you have your nation, the surrounding small nations, goods may come directly from China. Goods may travel to Mauritius. From Mauritius, goods may come to India. Goods may travel to, say, Singapore. From Singapore, goods may enter into India. So these goods which are coming, it may come from one nation directly, or it may come from another nation via to India. So this committee has done a research saying that we have done a thorough analysis where the cheap glut, that is, they have proved that statistics that 50% of the consumption is happening by way of imports, which is causing a threat to Indian manufacturers. And on the basis of application filed by these manufacturers, committee came into opinion saying that 5%, your protective duty has to be imposed additionally. And this was imposed for a span of 5 years. 5 years. Out of interest, if any one of you are really interested to get into this profile, look at this notification. Fantastic way they have done a research. In an internal audit, suppose if you want to give any management report to any of your clients, we refer to something called due diligence. Due diligence. This one report is a classic example how you study about a company, how you analyze the competitor, how you analyze a market based on various statistics, how you come into conclusions saying that these are the products which are getting glutted into India and we should protect this particular manufacturers. So this is first provision, protective duty. So protective duty is additional duty which is additional to the regular duty. And this is on the basis of article which is manufactured in India. On the basis of that, they're going to make a comparative study. And whenever government, the Ministry of Finance comes with levy of protective duty, prior permission of Parliament is required. And what if, said this summer season, winter season, there is a holiday for the Parliament? Then they can come out with a notification and subsequently it can get ratified. Now, these are all of national importance. I call this as national importance. So where if my parliament, the upper house is not functioning or the lower house is not functioning, the government cannot wait. They come with a notification instantly. And whenever this lower house and upper house is working, they put forth this notification, get it ratified saying that we have levied this particular preferential protective duty. Kindly approve for collection of taxes. This is your starting point called protective duty. Let me see if there are any doubts before we go to the next duty. Mansa, be very, very patient. Don't jump into a conclusion. Anti-dumping duty, there is a separate provision. This is just to start protective duty. Anti-dumping comes at a later point in time. I'll slowly take you through. Now, there are multiple duties. Safeguard duty, anti-dumping duty, then your subsidized duty, this protective duty. So just keep understanding these topics and look for the respective topic. Yes, Mansa, it is by way of special resolution in a public interest. Next, export duty and import duty. This is just section 8 and 8A, general provision where they say refer to second schedule in case exports, refer to first schedule in case of imports. Just basic provision with respect to import and exports. Next, safeguard duty. Next is section 8B. Please open your working note. You will get confused. Write down this. Put the heading section 6. Put the heading section 6 hyphen protective duty. Section 6 hyphen protective duty. Below that, write down section 8B. Section 8B hyphen safeguard measures. Safeguard measures. Now, when you wrote section 6, you can write in brackets protective duty. You can write in brackets application by Vedanta Limited. Application by Vedanta Limited. Now, whenever you refer to your working note, students, you'll understand any person who suffered, they bring to the knowledge of committee, then the committee takes an action. So this section 6, by way of application, they have taken an action. Now I'm coming to next section called section 8B, which is called safeguard measures. Safeguard measures. Now, this section 8B, it says that there are circumstances which are indicating that there should be some safeguard measures. Why? Articles are imported in increased quantities. Point number 1, the research committee or this particular ministry is noticing that suddenly there is a increase in import of these articles, or this whatever importation is happening, this is going to be a threat. This is going to be a threat, and it is going to cause an injury to the domestic industry. It is going to cause injury to a domestic industry. Now I'll give an example. For a moment, assuming that I am a manufacturer of this car tires, rubber tires, CA, MRF, Dunlop, Apollo. Say I'm a manufacturer of this rubber tubes and tires. So when I manufacture this tire, I'll sell to OEM, I'll sell to in the open market. Suddenly, I see that the manufacturers may not realize, but there is an increase of imports which is happening. Application was not filed by any of these manufacturers. The government of the Ministry of Finance has felt that there is a sudden rise, there is a sudden increase in imports, and they felt it was indicating that this may result in injury to a particular domestic industry. That point in time, they can use a power by way of 8B to invoke a duty called safeguard duty. Now, this is one example which was taken for your consideration, where this ministry has come out with a detailed analysis saying that there is a country of origin by name called People's Republic of China. So from this particular country of export. Now here, look at this analysis. Goods have shipped from China, manufactured in China. It also was exported from China. And also they have given name of a manufacturer, the producer. They say Jinagasu Chengde Steel Tube Share Company. So this is a manufacturer who manufactured. What are the products? These are the products which are manufactured. What is the product? Seamless tube pipe, hollow profile, iron, alloy, or non-alloy, steel cast. Now they have said that there is a components of steel, which they have identified into category A1, 1, A1, 2, A1, 3. They say that this is the amount on which you have to pay your customs duty. That means to say, whatever your transaction value is there, in addition to transaction value, they say this is the safeguard duty which needs to be paid per metric ton in US dollar. So they have identified, they have come into a conclusion saying that something serious is going to happen on the basis of, these are the notifications. When we refer to section 8B, there are various notifications. This is a notification which was issued in the year 2022. I'll give you a citations at a later point in time where you can refer and understand these particular provisions. So here, intent of the government is imposition of safeguard duty. Why? Because they felt that there is a serious threat which is going to happen to this industry. Students, we are at 7:30. Let's have a break for 9 minutes. Let's resume back at 7:40 to continue with our discussion. Let's have a small break for 10 minutes. 7:40, let us resume back now. In my question window, there's one statement given by Balaji. So customs provisions are quite interesting in today's class. I acknowledge your statement, Balaji. It's interesting. At the same time, you should have the interest and patience to read the provisions and understand what was the intent and why these provisions are, and what happens if these provisions are there. So I too acknowledge your statement that that's quite interesting. Right? Let's continue with our discussions. Now, so whenever there is an issue like this gluttering of the goods into India is happening, imposition of duty. This is one particular point. Generally, anyone gives a recommendation. Is there anything else can be done? Second option, this is little important. Application of tariff quota. Now, this tariff quota, probably examination, you can expect a 3 marks question in your final. Define the term tariff quota and when it will be used by the customs authorities. At that point in time, you can give a little background on section 8B, where you will refer to safeguard measures. Under that, you will explain this tariff quota. Now, tariff quota is a reference. Tariff quota, I'll mention this way. This tariff quota is a reference where quantity restriction is made on quantity imports nation specific. Now, this is a diplomatic thought process where the government cannot suddenly stop saying that stop imports from China, stop imports from Malaysia, stop imports from, say, Taiwan. Now, that is going to create an imbalance between two countries. Rather, they can come with some other proposal saying that, look, I can fix a quota that is called quantity. Now, this quantity is on the basis of, say, last 3 years average. They'll say, look, year 2017, 2018, 2019. From your nation, this is a quantity of imports which have come. I do an average, and up to that particular quantity, I'll let your goods come into my nation. Beyond that, I'll not permit to allow the goods to come. Now, these are the ways how innovatively we will come to protect the interest of a nation. So here, the committee consent or the ministry can come with something called tariff quota. So tariff quota is fixing a particular quota that is in terms of quantity, beyond which the goods cannot be permitted to get into India. This is the second possibility. Third, any other measures. So any other, what they feel as a good practice, they can impose any other such practice also. So tariff quota, the central government may allocate tariff rate quota to supplying countries. Now, this is as per your second number point, supplying countries. So whichever nation from where these imports are happening, that nation specific, they will say, this is what I'm going to permit you. This safeguard duty is in addition to any other duty. So here they say that I want to levy a duty called safeguard duty. So Mansur, please understand, this duty, safeguard duty, is to protect in a particular commodity or a manufacturer where they feel there's a threat to the particular industry, domestic industry. And why is that happening? It is because of the commodity which is coming in an increased proportion. There's no application being done. It is by virtue of sudden increase. Now, one classic example you can think of is your rubber tires. This rubber tires is one example post-COVID. Suddenly there was an increase from China, where they have imposed this safeguard duty. And this is one example. stainless steel or steel commodities where imports from China, they have imported something called this safeguard duty, and this safeguard duty, in addition to the regular customs duty, what we have to pay. Next. Once I have fixed the safeguard duty, as I said, this quantitative data, I'll go on the basis of last 3 years average. And this safeguard duty, once they have imposed, 4 years is the time for which this duty will be collected. From the day they have imposed this particular safeguard duty, 4 years is the time limit where that notification will prevail. After that 4 years, automatically the notification will be having no vacancy. It will not be effective. Government might, in case if they feel that no, this is not good enough, 4 years, we have to extend the time limit. They can go up to maximum 10 years. Now, as I spoke about safeguard duty, there are a few exemptions. That means I cannot give the same treatment to all transactions. No, transaction to transaction, person to person, have to make some decisions altered. So here they say, in case if there are articles which are coming from developing country, so long as share of imports of that article from that country does not exceed 3% of total imports. So in any one country, if you see, if the total imports is up to 3%, they say, I don't have any issue. I will not impose safeguard duty. No imposing safeguard duty. So here, as long as my articles are within 3% of the total imports from a particular country, then I will not impose safeguard duty. Sir, what if multiple countries are there, not one country? Now, this list of developing countries you will get from World Trade Organization. There are list of countries which are identified as developing countries. India is one among the developing countries. So if there are 4 or 5 countries together which finds itself in developing country, then they say that for one, I say all countries put together, I'll say 9% as my tariff rate quota. That means to say all my aggregate of imports, if it is less than 9%, I need not levy my safeguard duty. Similarly, exemption is there for imports by EOU, imports by SEZ. Now, EOU and SEZ, they don't consume the goods in India. Whatever goods are imported in India, they process and they send it back out of India. So those goods which have come into EOU, those goods which have come into SEZ, as long as it is going back out of India, no safeguard duty is imposed. So what if the goods have come into EOU, from EOU it is coming to domestic tariff area? Possibility is there. Now, tax planning, tax evasion, or killing a particular economy can be targeted in any fashion, any direction. So those cases, they say that in case if it is coming to EOU, from EOU it is coming to DTA, then all those domestic clearances shall be subjected to safeguard duty. Like example, the previous slide we have seen this steel which is imported from China. They say this particular manufacturer who is selling the goods, we feel that there is a safeguard duty applicable. So this EOU unit goes and says, sir, I'm an EOU, please don't levy safeguard duty. They will permit to get the material. From EOU, if I sell the goods within India, that point in time, whenever the goods go out of India into the domestic market, all those goods which are consumed from manufacture, sold in India, will be subjected to safeguard duty. This is the exception for your levy of safeguard duty. Next, write down in your institute material, Section 9, subsidized articles. Section 9, subsidized articles. Now, this is like Ajit Doval going into Pakistan, staying there, understanding the secrets, coming back and giving an advisory to the defense. Now, very, very interesting levy, subsidized articles. Now, here they say, first you understand the provisions, then I'll explain how this works. They say that any country or a territory, directly or indirectly, pays or bestows subsidy upon the manufacture or production or exportation of any article. Subsidy to include transportation. Now here they say that a country or a particular nation, what they're doing directly or indirectly, they're paying or benefiting the exporter. Benefiting the exporter. How? By way of a subsidy. By way of a subsidy. They say that like any goods manufactured in, say, Taiwan, if those goods exported out of Taiwan, there is a subsidy given by the government to that particular manufacturer. Now, that is the case where they call it as a subsidized articles. Such articles where there is a subsidy given, those are imported into India. And these articles may be in the same condition as when exported from the country, or may be changed in the condition, by the manufacturer or otherwise. Now, very, very interesting provision. This is the way, look at the beauty they have drafted this provision. I'll give you an example to understand this particular provision. Say motor car. Take example GM Motors. As on today, GM Motors doesn't have manufacturing setup in India. And Fiat case. In Central Excise, one of the landmark judgment with respect to valuation is in case of Fiat. Now, Fiat or say GM Motors, for a moment, I'll just give a hypothetical example. Say, Fiat has got their manufacturing activity in China. Fiat has manufactured a car. This car travels from China to, say, this place called, say, Mauritius. Let me just see one nation which is close to China and India. Say Thailand. Now, the goods have gone from China to Thailand. From Thailand, these goods have been imported into India. Now, how it has come? It has gone as a motor car. They did the, this what you call tire they have removed, the chassis they have removed, CKD form. Completely assembled car, they have made it as a semi-assembled car, semi-knockdown condition. From Taiwan, this particular car, from this particular nation called, say, Malaysia, like Thailand. Let's take example, Thailand. From Thailand, the goods have come into India in a SKD condition. Now look at the way this planning is being done. There is a subsidy given in China. That goods have come into Thailand. In Thailand, they have opened up the parts in a SKD form, and from there, it has come to India. Now please remember, always when the goods move from one nation to another nation, there is something called place of origin. That is something which is mandatory to be given. International trade, wherever the goods are moving from one nation to another nation, the source of origin is something which has to be mandatorily mentioned. Now, like Ajit Doval, for a moment, the officer understands how these goods have come to Thailand. He will travel back. From where these goods have been procured in Thailand, he will travel back to China. Then they make a study. These goods were manufactured in China. Was there any subsidy given? And that subsidy suffered. Those goods exported to Thailand at a lesser price, and from Thailand, it landed to India at a lesser price. Now, for a moment, let's take example of this car called Fiat. 10 lakhs is the cost of the manufactured car. China government gives a subsidy of, say, 3 lakhs. So this 10 lakhs car has value of 7 lakhs, moved from China to Thailand at 7 lakhs. And from Thailand, with a nominal, say, 10% margin, it moved to India. 7 lakhs has become 7,70,000. Now, what is the normal price? Say, example, competition with Maruti. So, Maruti is prevailing at 7 to 8 lakhs. Now, Fiat has come to India from China in a different route, which is at a subsidized price. Now, this is the point in time where this provision, section 9 says that in case if these goods are coming in the same condition or different condition, even then I can levy a duty called countervailing duty on these subsidized articles. These are a couple of examples. 2019, I have taken this example where the government of India has identified. Look at this entry. Very, very interesting facts. Goods are manufactured in Malaysia, country of origin, country of export. So there are copper tubes which are manufactured in Malaysia, and these have gone to various other places, and this has come from any country including Malaysia. They have identified that there is a supplier called Metube SDM, Malaysia, and MedTube International, Malaysia. These two people have got a subsidy in this nation called Malaysia. And these goods, when it come into India, they have said that nothing doing. We have to levy a safeguard duty under this particular entry, because you have given a subsidy. We levy subsidized duty called countervailing duty under Section 9. So we call this as countervailing duty under Section 9. How they have done? As a percentage of CF value, they say 5.31% is applicable on copper tubes. Now look at the other entry. From Malaysia, any country including Malaysia, any producer other than producer mentioned at serial number 1. So they say only in case of this MedTube or this MedTube, 5.31% is countervailing duty. Any other percent from Malaysia, 11.53% is the countervailing duty. Now, this is how they have analyzed and they have looked at the nation's policy. Now here, sitting in India, I read customs provisions alone is not sufficient. Working in this tariff committee, you have to understand each particular country, what is the policy taken, what was the measures given to the industry, how that has impacted on export from that nation to India. Now look at the kind of statistics we need to have, the kind of patience we need to understand to analyze that these goods are going to have impact on the domestic industry. So here, point for us to understand, even if there is any practices, circumvent pressure measures, like they alter the description, they alter the composition. Now we should be in a position to trace it back, saying that, look, this has been originated from so-and-so nation, and this is the original description. Now the goods may come in the same assembled form or unassembled or disassembled form, like SKD, semi-knocked down condition. By changing the country of its origin or export. Now, when goods have come from Malaysia, now there will be an investigation done saying that, look, in Malaysia, you don't have a setup. You don't have a capacity to manufacture. How did you export those goods into India? The burden is on the importer to prove if they don't want to pay this subsidized countervailing duty. In any other matter, where CVD is rendered ineffective. So here they say that whatever be the trade practice, whatever be the equation they adopt, government, if feels that if there is a subsidy given in a particular nation where the goods have been originated, and that subsidy is going to have effect on my domestic industry, I levy something called countervailing duty, CVD, under Section 9. Let me see if there are any doubts before I go further. So far so good. Let me go further. Now, they say while levying this countervailing duty under Section 9, don't blindly look at this aspects. If there is a subsidy, not to be levied unless if there is a subsidy which is in relation to export performance, unless there is a subsidy which is used for domestic products over imported products. They are saying that any goods which are procured locally and which are considered for export, then please take that as a point of consideration. Subsidy is conferred on limited number of persons. Now here, this is another interesting point. If the government is giving subsidy only on the limited number of persons, it's not in the public interest. Not in the public interest. If you look at this subsidy given, generally they say, I give this subsidy as a tariff percentage, 10%, 15%, 20% to so-and-so companies. If there is a specific order given in that nation, that is the moment you take into consideration saying that, sir, because of that subsidy, my Indian domestic market is getting affected. Then what do you want to do? I want to levy a duty called countervailing duty under Section 9. And once I levy this countervailing duty, generally 5 years is the time limit for imposition. Now, in case of your Section 8B, it is 4 years safeguard duty. In case of Section 9 countervailing duty, 5 is a point in time. Now, I'm starting with next provision called 9A anti-dumping duty. Please write down in your working notes. Section 9A, anti-dumping duty. Anti-dumping duty. Now, please understand the backdrop, why this anti-dumping duty has come. What are the existing circumstances where this anti-dumping duty has come into picture? Now here they say, export price of a product imported into India is less than the normal value of like articles sold in the domestic market by the exporter. Now, I'll take you to a different slide to make you clear understanding on this. Say, let's take example of an exporter in Malaysia. Exporter in Malaysia. Say this exporter, I call him as say Mr. A. This Mr. A can sell in domestic market of Malaysia, can export out of Malaysia. Say for a moment, the selling price is say per unit, it is going to be say $150. $150 if he sells the goods in the nation called Malaysia. When he's exporting, he's selling for $120. Now, why is this disparity? He is selling within Malaysia at the rate of 150. When he's selling to export, he's selling at 120. Now, this is a case where a triggering point comes into picture saying that intentionally, this manufacturer, intentionally from this nation, the goods are being dumped to India. Now, this is a clear-cut case where $30 per product is a price which is charged lesser, because of which the domestic market India suffers. Domestic market in India is going to suffer. Now, this is called anti-dumping duty. Now, this, how we identify? There is a seller. This seller sells the price in his nation, sells the same product out of his nation. When we compare these two, there is an intention exists. There is an intent which exists to say there is a price gap. Now, this is an occasion where my anti-dumping duty provisions come into picture. Now, this is one of the occasion. This is one of the occasion where I can refer anti-dumping duty, means they have been dumping beyond or they're dumping with a predetermined intent to kill a particular market. This could be one mode, another mode. Now, let me just erase a portion of it. Saying domestic market, it is $150. Export is also $150. These goods are exported. For a moment, let us assume that from Malaysia, let me take example of Bangladesh. Mr. A, who is exporting goods from Malaysia to Mr. B of Bangladesh. From Mr. B, the goods are sold to Mr. C in India. See, Mr. A charges $150 per unit. So the cost of Mr. B is $150 per unit. Cost for C is, say, it's $120. Now here, there is a loss being made by B. How much is this loss? $30 per product. Now, this $30 may be an arrangement to fill the gap by A to B. Now, this happens in case of a holding company, sister company, or associated enterprises, where prices will be shown at par from one nation to another nation. From another nation, when it comes to India, there's a gap in the price. And this gap of $30, there will be a funding by holding company, maybe by way of a loan, by way of an investment, by way of a subsidy, or by any other arrangement. Now, when you read the case laws in relation to anti-dumping duty, we feel that what we learned in our chartered accountancy final FR paper is tip of iceberg. The way they analyze this financial statements, like they try to understand what is a cost sheet, how this cost has been derived, how the price has been influenced, and when they reported loss, how, like, what all products they are dealing with. In the given cost sheet, how many products they have imported, how many products they have manufactured, what is the value addition they have done, what is the cost of labor, how that is allocated among various products. These are all various factors they analyze. Then they come into conclusions saying that one of the product, there is a loss. This loss is covered by way of a higher price, higher margin in another product, or lower margin in another product, or by way of a viability gap funding, or whatever be the mode, where parent company is supporting the sister company for the gap in the working capital. Now, these are all circumstances which exist to prevail to say that there is a dumping happening to the country. Now, here, starting point is the export price of product imported into India is less than. So, imported price is less compared to normal value sold in the domestic market. So please write down under section 9A, additional dumping duty, anti-dumping duty, write down the definition for normal value. Examination, expect 3 marks question. What is the importance of normal value for computation of anti-dumping duty? This is how your theory questions will be framed. Now, what is a normal value? This is nothing but the value which is sold by the exporter in the domestic market, which is applied for like articles. So this is a price which is prevailing in the nation of export. So they say anti-dumping duty can be imposed only when there is an industry, Indian industry, which produces like articles, So this is my condition number 1. Condition number 1, where there is a price variance. Condition 2, when there is a Indian manufacturer locally. This is my second condition. Once I hope you are understanding that we cannot say everything like safeguard duty, countervailing duty under section 9, or protective duty under section 6, anti-dumping duty under 9A. Each and everything has got a different purpose, has got a different intent. So under anti-dumping duty, my one of the condition is price, there is a variation. Second condition is the price the product which we are dealing with has been manufactured in Indian market. And this duty, anti-dumping duty, important aspect is country specific. Now, in case of your countervailing duty, in subsidized articles, wherever the country, the material is coming from, to that particular country, I charge countervailing duty. In case of your protective duty, in case of your safeguard duty under 8B, irrespective of the nation, I charge duty. I repeat, Section 6, Section 8B. I don't look at the nation, I charge my safeguard duty, I charge my protective duty. But in case of my countervailing duty under Section 9, my anti-dumping duty under 9A, I charge country specific. Why? I can prove from this particular nation, the goods are coming into India. So let me charge only on those goods which are coming from that particular nation. Now, there is something called GATT, General Agreement on Tariff and Trade. This is an international treaty. Generally, like this World Trade Organizations, like they have some of the terms and conditions. They say, look, don't impose too much of tariff quota. Don't look at subsidy given by a nation very seriously for the purpose of levying countervailing duty. Though there are international terms and conditions, they say, whenever you want to levy anti-dumping duty, you can levy anti-dumping duty, but please restrict up to margin of dumping. Up to margin of dumping. Write down in your institute, your notebook, margin of dumping. Write down margin of dumping. What is the importance of this term? In the next slide, I'll explain in detail. Margin of dumping. Right? Now, lesser duty to remove injury to the domestic industry is permissible. I can levy anti-dumping duty. Maximum is margin of dumping. Lesser amount, whatever I want to levy to protect the injury, I can do that. Now, this is one particular notification extract. This is in relation to Nepal and Bhutan. Now, this is one extract from the recent 2022, like 5 years period where anti-dumping duty was levied, where government felt that we should extend this anti-dumping duty. I'll just read for a moment the logic and the explanation, the reasoning they have given. In the matter of review of anti-dumping duty on import of subject goods which are originating in the exported from the subjected countries, the designated authority in its final findings, look at the language, in its final findings, published in the original notification, the 2021, has come to the conclusion that there is a continued dumping of subject goods from the subject countries, and imports are likely to enter the Indian market at a dumped prices in the event of cessation of duty. So they say that if I am going to stop this anti-dumping duty, the goods are subjected goods, that is identified goods from the subject countries, that is identified countries, are going to continue to be dumped in our Indian market. So what they say, the dumped imports from subject countries are causing injury to the domestic industry. What do you mean injury? The local manufacturers are getting suffered. The information on record shows likelihood of continuation of dumping and injury in the case the anti-dumping duty in force is allowed to cease at this stage. So they say that at this stage, we don't want to stop. We don't want to continue. We want to continue. So they say there is sufficient evidence. Now look at the language. Sufficient evidence to indicate that revocation, that is cancellation of that anti-dumping duty at this stage, will lead to continuation of dumping and injury to the domestic industry, and has recommended and continued imposition of anti-dumping duty on imported of subjected goods originating from the subject country. Now I'll show you this particular slide where they have given list of those commodities and list of the nations where they say we need to have this anti-dumping duty for another 5 years. So here, look at the table. They have identified that these goods are originated from Bangladesh, and country of export is also Bangladesh. So here it didn't move from one nation to another nation. Rather, from the same nation, this anti-dumping duty is taking place. Also, look at the boldness. They have said that the manufacturer is Hassan Jute Mills, Alijan Jute Mills, Sonali Anash Industries Limited. They say that any products which are, that is jute yarn, sacking bags, jute yarn. They have given the HSN number also. So in case of products which are imported, what is the rate of duty? In case of first line item, they say nil. Second line item, they say nil. Third line item, they say 20 rupee 35 paisa per metric ton, $20.35 per metric ton. Similarly, in case of jute yarn, they say 20.35 dollars per metric ton. This is how they have recommended that whenever someone is filing a bill of entry. Now look at the way imagine the burden, imagine the kind of pain is there on the customs officers. These days, now everything is electronic. After electronic data, the moment a programmer writes a program, if an importer comes and files his bill of entry, the moment he says 5307, there is a notification under anti-dumping duty that comes in clock saying that under section 9A, for this particular 5307, there is anti-dumping duty. Then they'll say, where is the country of origin? Bangladesh. If it is there, then what is the amount of duty? They'll fix $20.35. So this is how these days, electronic era, it's easy to monitor. Imagine 5 years back, imagine 10 years back, imagine 20 years back. Now, 20 years back, we didn't have internet. All the data was to be collected manually. You have to go from one nation to another nation, look at the policy over there, look at the tax matters there, analyze. Now, sitting in India, the research wing does a fantastic job. And take it from me, if you feel CA is tough, I would say the job of these officers who issue notifications is pretty complicated, very, very complicated. And for us, after qualification, we just look at this notification and we just need to pay anti-dumping duty. But the kind of investment they do in research, looking at the financials, looking at the country, whether there was a price prevalent, what is the domestic price, and they should have evidence. Like, no, if this notification comes and says for this particular jute product which is imported from Bangladesh, you have to pay $20.35 per metric ton. As an importer, I can just file a writ petition under Article 226 to High Court. Now, when I file a writ petition, the straight, simple question I'll ask, on what basis the customs authorities have levied this anti-dumping duty? Do they have evidence? Now, imagine the plight of the officer. They have to prove with an evidence that this is the price which is available in the domestic market. This is the price which they are selling to the Indian market. And look, this is the gap because of which we have fixed at 20 rupee, not rupee, it is $20.35. Look at the kind of nitty-gritties they have. They are also fixing $20.35 per metric ton from Bangladesh. So they have done so much of analysis, and then this notification has come into final version. Moving on. Now, this is what I was telling you. There is something called margin of dumping. Now they say that whenever you want to levy anti-dumping duty, I'll give you two choices. Choice number one, margin of dumping. Choice number two, injury margin. So here, my margin of dumping is derived on the basis of price prevailing at the origin. So here, in the previous example, we were talking about Bangladesh. So what is the local price in Bangladesh? What is the price used for export in Bangladesh? So here, local price is assuming $150. and export price is $120. So here I get my anti-dumping duty as margin of dumping $30. So this is first method. I call this as margin of dumping. Examination, 3 marks theory question. Explain the term margin of dumping as per customs provisions. Then you will explain the background of section 9A. Sir, should I need to quote section 9A? If I don't quote, will I get any minus marks? Absolutely don't worry. You can just say, as per the Customs Tariff Act, as per the provisions of Customs Tariff Act 1975. But don't do blunder. This section 9A, when I am referring, it is Customs Tariff Act, not Customs Act. You can say, as per the provisions of Customs Tariff Act 1975. 1975. In case if there's a product which is originated from a country where the selling price of the export price of the commodity from that nation is lower compared to the normal price prevailing in that particular nation, then there is a anti-dumping, there is a dumping which happens to a particular nation. The gap between normal value and export price is called as your margin of dumping. Write in your simple English, and I would recommend, if possible, put this formula in your English, because you may write English for 3 lines, 5 lines, it doesn't matter. When you put this formula, normal price minus export price, good enough. The moment this formula is there, 2 marks are straight away given to the student. The balance 1 mark for explaining the backdrop of 9A in relation to anti-dumping duty. Is this clear? Before I go to injury margin, let me see if there are any questions. Students, are we clear on this margin of dumping? Sunil says clear, Balaji says clear. Great. Let me continue further. Next, export price. Now, when we do this export price, they say price in relation to article exported from that country. And construed export price. Export price is not reliable due to association. Now, look at the way this transaction price was discussed. They say export price is not reliable due to association or compensatory arrangement between the exporter and importer. Now, for a moment, let us assume that Kubota INC, Kubota, I'm just taking a hypothetical example, Limited. This is there in Taiwan, and this is India. Look at the language. They say export price not reliable due to association or compensatory arrangement. Now, when I say compensatory arrangement, I wash, I charge 150, I give a discount of $30. Or third party. Now look at the language. They also brought in third party also. Now you can have a deal A, B, C. A is selling to B at a fair value, that is normal price. B is selling to C again at fair value, normal price. A is giving a discount to B, B is giving a discount back to C. So if a tri-party discount is there. So export price shall be first resold to an independent buyer. So whatever price is being sold to an independent buyer, that will be picked up is what they're saying. So on records, $150 is billed Kubota INC to Kubota, and local normal price is also say $150. Assuming for a moment this happens to be 12,000 in INR, rupees 12,000. This is offered for customs purpose. Now, for a moment, Kubota Limited is selling to an independent buyer in India. Independent buyer for rupees 8,000. Now, this is what they're saying. I'll pick this as my construed export price. Construed export price. Now, what is happening here? This company, Kubota Limited, though its landed price is 12,000, they're selling at 8,000 to an independent buyer. Why? This gap between 12,000 and 8,000 is funded because of their association. It is compensated by way of some arrangement. So for that, all reasons, when there is a associated party transaction, a related party transaction, refer to your notes to accounts. In notes to accounts, say, your accounting standard 18, related party transaction. Whenever related party transaction is there, I will set aside this transaction value. I'll consider the price which is sold to an independent buyer. That is how I take my export price. Then next, injury margin. Now, anti-dumping duty, we have two mechanisms. One is your dumping margin, that is the gap between that nation and the export price. Second is injury margin, where I prove that there is an injury caused to the domestic manufacturer. This is a little complicated. They say whatever is the failed selling price in the Indian industry and landed value of dump imports. So when I say landed value in the previous example, you have this 8,000. This I call as landed price. So they're saying that in case if the goods are manufactured in India, for a moment, Kubota Limited is a Indian manufacturer, is selling at rupees 8,000 to an independent customer. So I'll say 8,000 is the price which is sold, which is landed value. Selling price in India, say it is 10,000. This is rupees. This is also rupees. So here I get a gap of rupees 2,000. So they are saying that please levy anti-dumping duty for the injury margin which is happening in India or the margin of dumping which is happening in overseas. For a moment, in the overseas I had $30. Now $30 into 80, if I get 2,400, lesser of 2,400 or 2,000, whichever is less, that will be considered for my anti-dumping duty. This is the provision with respect to section 9A. Let me see if there are any doubts before I travel further. Kaushik is asking this question. Sir, in case of anti-dumping duty, time limit is 5 years. Can it be extended? Answer is definitely yes. Any anti-dumping duty which is invoked for 5 years, it can be extended for another 5 years. Mansa, hope you are clear with anti-dumping duty, ma? And others, let me know if you have any doubts before we go on other provisions. These are important. Examination. What is tariff rate quota? Under what circumstances tariff rate quota will be used? What do you mean by safeguard duty? What is meant by injury margin? What do you mean by dumping margin? Margin of dumping. So these are the questions which are asked in a indirect fashion. Now, if you don't read these provisions, absolutely you'll not understand. But if you really like the way the law was drafted, if you understand the concepts, you'll really appreciate these provisions. Let's move on further. Thanks for the confirmation, Kaushik. Now, anti-dumping duty, as we have exceptions, they say that any goods which are imported by EOU, generally they will not charge anti-dumping duty. Intention, 100% export-oriented unit. Goods come into India, go out of India. Now, as an importer, if I say, sir, I'm an EOU, then anti-dumping duty will not be applicable. What if it has come to EOU? From EOU, it is coming to DTA. Then, yes, anti-dumping duty is applicable. Then, imposition of duty. Now, this is the only provision which can have a retrospective effect. That means to say, any notification which has come under anti-dumping duty, till 90 days back, from the date of notification, it can have its effect. Very, very important. MCQ, 1 mark, you can expect 1 question. They'll give you following following duty has a power of retrospective effect that is 90 days from the date of notification. Below that, A, B, C, D. They'll give you protective duty, safeguard duty, anti-dumping duty, and countervailing duty. Answer will be anti-dumping duty. This is the only provision where, post facto, they get to know that this dumping happened, because of which there is an impact to the domestic industry. So this reason they wanted to remove that severity, where 90 days backwards from the date of notification, this will be effective. Now, they say that I cannot levy countervailing duty under Section 9 or anti-dumping duty under 9A parallelly. Now, you decide whether you want to levy countervailing duty or you want to levy anti-dumping duty. You want to understand, was there a subsidy? If there is a subsidy, please levy CVD. If there is no subsidy, then you can choose anti-dumping duty. But both levy on the same article, both aspects together. Clear? And just because the goods are exempted, just because there is a refund in the country of origin, it doesn't trigger in general for countervailing duty or anti-dumping duty. Section 9, subsidy. If there is a general rule to give some subsidy, like we have duty drawback. In India, the way we are doing the analysis, now India, if you see, there is something called all industry rate, that is your duty drawback. Duty drawback, which is there at the rate of 2%. Now, when duty drawback for 2% is there, it doesn't mean that Indian government is giving subsidy to their exporters. Now, this is a public policy. So similarly, the provision says that just because in the country of origin or exportation, if there is a refund, don't consider that this is on account of subsidy or it is on account of anti-dumping duty. It should be a specific cause to draw your levy of anti-dumping duty or countervailing duty. This, I'll skip, it is a general provision. Mansa has asked this question. Beginning of the class, she had raised this doubt. Sir, please explain social welfare surcharge, which was referred in a particular page of institute material. She was saying page number 1.17, there was referred to social welfare surcharge. So Mansa, your doubt gets clarified here, ma. The social welfare surcharge has been imposed in Finance Act 2018, where they say they wanted to collect 10% cess, which is like the surcharge, which is called social welfare surcharge. This is in lieu of education cess. Earlier, 4% was the education cess and cess which is being levied. Now it has been replaced with social welfare surcharge for 10% for education, health, and social security. So they say this is leviable on all duties and taxes which is collected under Section 12 of your Customs Act 1962. And I don't levy social welfare surcharge on safeguard duty or countervailing duty or your anti-dumping duty. Please write down 1 mark MCQ question. This will be tested for 1 mark MCQ. Write down social welfare surcharge. Social welfare surcharge is not applied on Section 8B hyphen safeguard duty, Section 8B safeguard duty. Section 9, subsidy or countervailing duty. Section 9 hyphen subsidy or countervailing duty, comma, section 9A, section 9A hyphen, section 9A hyphen, anti-dumping duty, anti-dumping duty. Now, this calculation, wait for the next class. In the process of valuation, I'll explain in detail how I determine the valuation and how do I calculate my duty to be payable. So, with this, we come to the end of provisions connected with your various duties under Customs Act, Customs Tariff Act 1970. Hope this is clear now. Now I'll move on to the next important topic. We are at 8:36. We have roughly another 25 minutes to cover this classification. I'll give you the backdrop and then I'll come to this classification. So 1975. Classification rules as per Customs Tariff Act are relevant under GST, are also relevant for imports or export. Now, to identify the rate under GST, to identify the rate of duty, to identify the rate for payment of GST, to identify the rate of duty for import and export, classification is the important aspect. What do we mean by classification? By virtue of classification, I identify the HSM. I, as a manufacturer, as a trader, as an importer, as an exporter, I identify what is the HSM applicable for the goods. Applicable for goods. Now, impact of wrong classification. Impact of wrong classification. One, payment of differential duty or GST. Second, interest on short paid duty or tax. Third, penal provisions. This is one starting point when you get into practice in indirect taxation, where the first and foremost you will start with making a classification study. I call this as study on classification. That means to say, you as an expert, you'll try to understand what is the product which is manufactured, which is traded, which is imported, or which is exported. As a GST registered person, as an importer exporter, have I paid the duty properly? Have I paid the taxes correctly? Was this classification correct enough? This is one side. The another side, if I enjoy any incentive by way of duty drawback, or if I enjoy the benefits of MEIS scheme under foreign trade policy, or if I have enjoyed any of import benefits under foreign trade policy, then This will have an impact of tax plus interest plus penalty. This is a severe impact where I as an importer or I as an exporter, say I have exported the goods. For a moment, I have exported a particular computer. This computer has been loaded with particular Microsoft Office. If I export a computer with Microsoft Office and if I call as a computer, scenario number one. If I have exported a computer without Microsoft Office, without operating system. Now, a computer with Office with operating system, computer without Office without operating system, both are not comparables or both are not the same. Now, there is a thin line of differentiation. Look-wise, both are like computers, both are maybe laptops. But if I have to classify by chance, instead of classifying it 8436, I have classified as 8450. Now, 8436, I get a duty drawback of 2%. 8450, I get a duty drawback of 5%. For a moment, this is a right classification and this is a wrong classification. If I have selected 8450, I'm going to get a duty drawback of 5%, much higher than what I have to get. This results in a demand of the duty drawback with interest and with penalty. So these are the repercussions, these are the ramifications under GST law, under your customs provisions. Let me see if there are any doubts before I continue further. Shivam is asking this question. Where can I get the bare rules of classification as per Customs Tariff Act? Shivam, in Customs, the CBIC portal, there is a reference to these rules. What I will do next class, whenever I share my material, I'll give you this hyperlink on my PowerPoint presentation so that all of you can download these rules and also this Customs Tariff Act. So I'll keep in mind and I'll give you this material. In the subsequent material, you can download that. Let's come back to classification. Classification, import and exports. So to start with, Customs Tariff Act 1975. This Customs Tariff Act 1975, just give me, yeah. So to start with, Customs Tariff Act, this has got general rules of interpretation to first schedule, that is import tariff, and explanatory notes. Now, there are 6 rules available for interpretation. These are guiding principles. These are akin to your generally accepted accounting principles. That means to say, how do I choose my policy for depreciation? What is the relevance of consistency? What is the relevance of accounting period? So as I have various concepts and conventions, part of my generally accepted accounting principles, these rules of interpretations are relevant for me to identify my HSN. Now, when there is a practical issue, how we adopt these rules, I'll give you with various practical examples. Also, we have 3 explanatory notes which defines how to read the tariff. So when I read that this particular schedule 1 or schedule 2, what is that I have to understand and what is that I have to conclude for selecting particular HSN number. And all these explanatory notes, these rules are integral part of your schedule 1 of customs tariff. As on today, we have total 98 chapters. 01 to 98. I call them as chapters. These are put into various sections where 21 sections were made together. We call that as a homogeneous grouping of various chapters. Now, I'll see if I have this notification, I'll just see if I can show you the overview of your customs tariff act. Yeah, I'll just take you through my presentation to Microsoft, this Chrome, where I'll show you the first schedule to the import tariff, how it looks like. Hope you can see my screen. Let me increase the size. Yeah. This is my first schedule. I call this as import tariff, where I'll get to know basic rate of duty, classification, tariff items. Now, I have chapter 1. Chapter 1 deals with live animals. Chapter 2 deals with meat and edible meat. Chapter 3, fish and predators and mollusks, dairy produce. Now, you can see these are all various chapters. Now, these chapters are running up to chapter number 98. Now, this is I call chapters. Now, if I select 84, 85 is commonly used. Let me use chapter 85. If I open chapter 85, now look at this chapter 85. It has a heading called Electric Machinery and Equipment and Parts thereof. Electrical machinery and equipment and parts thereof. Sound recorder and reproducer. Television image, sound recorder, reproducer, and parts and accessories of such articles. Now you can see this chapter number 85 is covered in chapter number 26. Sorry, section number 26. As I say, there are 98 chapters. These 98 chapters were put into 21 sections. So this is covered under section number 26. Now, probably it's a typographical error, 29 sections. So here you can see chapter number 85, all your mobile, TV, radio, or your electronic gadgets, everything falls under 85. Now, if you see this chapter 85, this has got a section notes. They say this is falling under section 26. Section notes, they have given some English to make you understand what is covered in this particular section. Then you have something called, okay, let me come back to my presentation. I'll take you one by one. So first, to start with, I have to see where does my product fall in the given 98 chapters. So again, I'll take you back to this 98 chapters to have a better understanding. Say for a moment, I have to deal with this rubber products, rubber tie tube. What I'll do, I'll just search for rubber. Now you can see here, chapter number 40, rubber and articles thereof. Chapter number 40, rubber and articles thereof. So here, each particular chapter has got a heading, organic chemicals, which is used in your agriculture, fertilizers, chapter number 31. So the heading itself will give you that whatever item you're looking has got an entry over here. Say another commonly used, your textiles, silk, chapter number 50, wool, chapter number 51, cotton, chapter number 52. Yeah, this is how I use my chapters. Let me come back to my presentation. Now, every particular chapter has got various sections. They say that this particular chapter, whatever you have, they have grouped into various sections. Not that technically relevant for you. This chapter has got a section which is divided into various chapter and subchapter. So usually this chapter has got, say, like rubber products, in rubber or electronic products. These are the sub chapters. So generally chapter has got a chapter notes and sub chapters. And each of those chapters has got a heading, and heading has got a subheading. I'll show you this electronic products where you will see this heading, subheading, etc. Say, this is my chapter number 85. In chapter number 85, this we are dealing with electronic products. So I have something called chapter notes. What do they see here? This chapter 85 deals with electrical machinery, equipment, parts thereof, sound recorder, reproducer, television image, sound recorder, reproducer, parts and accessories thereof. Like for a moment, floppy disk. I don't know how many of you have seen floppy disk. All of you know this pen drive. Now, is the pen drive classifiable under 85? Parts and accessories of such article. Now, electrical machinery equipment. I can call my laptop as an electrical equipment. It's not mechanical, electrical, which operates on a electricity. I can call electric equipment. So a pen drive, which is part or accessory. Similarly, a mouse. If I purchase a keyboard, my keyboard and mouse may be a part and accessory of this electrical machinery. They say this chapter does not cover electrically warmed blankets, bed pads, etc. Articles of glass, which is covered under 70. Now, they are giving a clarity when you read this particular entry number, chapter number 85. Few things you read, few things you don't read. They are giving a clarity here in this chapter notes. Now, I'll go further down to show you this subheading and other notes. Look at this subheading notes. Now, I said heading, subheading. I'll show you the entry. Then you'll have a clarity on this. Now, here, remember the first slide I've shown you, tariff item. Now, this tariff item, you have 8501. So, 8501 is going to indicate that this is my HSN, which has got a chapter called 85, chapter number 85. Under chapter number 85, you have 01, which deals with electric motor and generator. Electric motor and generator. In this, I have a first heading called motors of output not exceeding 37.5 megawatts or 37.5 watts. Now, this has got a subheading. Look at this hyphen. Hyphen indicates heading. 1 dash indicates heading. 3 dash indicates a subheading to the main heading. So here 8501 deals with electric motor and generator. Like what do you mean by generator? Now when the power goes off, I need to have a power backup. That's called electric generator. So if there is an electric generator which has a capacity up to 37.5 megawatts, then I put into 8501 further 10. Look at this 6-digit level classification. As on today, for GST purpose, for customs purpose, you can have this 6-digit. India, we have 8 digits. When you look at your bill of entry, you'll have 8-level classification. So here they have said for micro motor, which is having a tariff number 85011011. This is my 8-level entry. So they say micro motor is a subheading under the heading called motor, under the main heading called electric motor. And they say rate of duty 15%. So as on today, my customs duty is 15%. And what is the unit of measurement? They say units. 10 units, 5 units. I can have numbers, I can have pieces, I can have quantity, I can have length. So is there any preferential rate of duty? They say nil. When preferential rate of duty is there, country specific, I can choose that while filing my bill of entry. So as of now, 15% is my customs dated. Let me see a couple of other. Yeah. Look at this entry. Now, unit of measurement, let me see something else. I have chapter number 85 8505. So in chapter 85, heading subpart called 8505. This is electromagnet, permanent magnet, and articles intended to become permanent magnets after magnetization. Electromagnetization or permanent magnetic chuck, clamp, similar other holding devices, etc. Now, these items, they have unit of measurement as kg. So they say ferrite core, any item which is having a description of ferrite core falling in this entry, you have to pay your customs duty at the rate of 7.5% per kg. So if I have imported 10 kgs, per kg 7.5%. Now a unit of measurement is kg. So 7.5% is the duty on the value determined under section 14. So this is how I look at it. Now if you look at here, students, you have 1 dash, you have 2 dash, you have 3 dash. Now this nomenclature is like, this is a subheading to this main heading. This is my main heading. To that, this is a subheading. Now I have come one level down. This 2 dash indicates I have come one level further down of metal, and 3 dash indicates one level further down, subheading. So you can see the number also, 8505 has gone up to 850511. With the subheading, it has gone up with 10. 85051110. One more layer, subheading, I have come down. So this dash dash or this triple dash indicates that these are subheadings. Let me come back. Chapter notes have explained headings, subheadings having. And this is a symbolic way how I read heading, 2 dashes or 3 dashes. So 1 dash is indicating it's a description of an article of main heading. 2 dashes, subclassification of the previous heading. 3 dashes, this may be a subheading or subclassification for the previous classification or main heading. Now, examination, this will not be tested, just for your understanding purpose. This I have explained. Now, in general, this generally accepted accounting principles, how I have to use. Rule 1. Rule 1 says that whenever you look at this chapters 01 to 98, please look at the heading. Whichever heading is giving a classification, clarity, please use that. No need to go to the rules. That means to say, for example, rubber. I've showed you entry number 50. I have found my rubber products. Here, entry number 40, I have found my rubber and articles thereof. Now, if I found rubber and articles thereof, straight away I'll go into chapter number 40. So what if I have a pencil, which also has got an eraser, which is kept beneath the pencil. Now, should I call this as a pencil? Should I call this as an eraser? Now, eraser is made of rubber. If standalone eraser is sold, which is having a characteristics of rubber, I'll go to chapter 40. Rule 1 says, your product has got a specific reference to chapter heading. Please go with that. Don't go to the rules. No need to go to the rules. Where you have a composition, like your pen, what you are seeing here, this has got a eraser attached, pencil attached, multiple functionality. Then go to your interpretation rules. Coming to interpretation rules, I'll go to rule number 2. In rule number 2, I have incomplete or unfurnished articles. Now what happens is, sir, I am at the verge of converting this as the assembled unit into a laptop. I have monitor, I have keyboard, I have integrated circuit. I have assembled all the things. I am yet to give the battery power connection. Now, any laptop which is sold in a uncompleted fashion, that means laptop is not assembled, monitor is not assembled, battery is not assembled. Then they say, as per rule 2A, look at the characteristics. If this functionality, if this is going to yield in a product called laptop, please classify under 85. So what if I wanted to sell in an unassembled or disassembled form? You sell. When you assemble, what do you get as a finished product? Laptop. So please classify as 85. So rule 2A says that whenever you have items which are in a semi-finished, means not completed, for what various reasons. I wanted to do testing in India, only then I'll use it as a laptop. So in those cases, look at the essential characteristics. If it's going to perform as a laptop, please classify as laptop and a 85. Rule 2B, classification of mixtures or combinations or substances. Now here, they say that when you have 2-3 components mixed together or substances which are clubbed together. Now, how do I identify the combination? For a simple example, say you have this tamarind. Tamarind is an agriculture produce. Now, tamarind, I can use the tamarind extract, I can use it as a masala powder. Now, a dry tamarind, should I call as agriculture produce, or this dry tamarind with the paste with some liquid which is used as a masala powder, should I call as agriculture produce, or should I call as a masala product? They say that look at the material, look at the substances. Now, when you have 2-3 products clubbed together, clubbed together, what is the essential character which comes out? Now, when I use tamarind standalone, I can use it for my various domestic purposes. But this tamarind, when I render with 2-3 nuts and powders and mixtures, which is used as my masala powder, then look at the essential character. It is, though, since tamarind was mixed with 2-3 products, then please call that as a masala powder. So what if I fail to apply rule 2A, I fail to apply rule 2B? Various reasons. That means I don't get a direct entry, I don't get the essential characteristics, I don't find what is the substance in that particular product. Then please go to rule number 3. In rule number 3, they say that when I fail to apply rule 1, when I fail to apply rule 2, then please come into rule 3, where equality of specific. So here they say, when you don't get an answer in rule 2A, please look at the description of a product which gives a complete meaning for your product on hand. Say example, I have this soapberry nut. Now, I don't know how many of you have seen this soapberry. This is a natural ingredient which is a substitute to shampoo. So if this soapberry product, if it is made into powder, I can sell as a soapberry, I can sell as a soapberry powder. Now look at the common description which gives a meaning of the end product. This soapberry product, when I made into powder, it is as good as my shampoo. So where I get the natural detergents shampoo characteristics, use that theory called principle of general equality. So on the basis of principle of general equality, what commonly suits for the material, that will be adopted. So what if I fail to find a specific 2-3 combinations which gives the same meaning? I don't have that situation. Then they say, go on the basis of essential character. That means whatever is commonly put together and sell with something else. Like I sell laptop, I put into a bag. The way does this fit into other product? That means if I sell a bag, jute bag, along with laptop, does it form as a container with laptop? Then please identify something else. Means the product is losing its essence. The product is losing its identity. See whether you can choose it with something else. Sir, I failed even in that case. Then look at all the entries, whichever is coming in the last, that will be the classification. Classification on the basis of similarity. Look at common products, whichever, like if you fail rule 3 also, what is the other common product on the basis of the similarity of the characteristics? Please identify that classification to this particular product. Now, basis of, there is something called common balance theory, that particular product. Now, this is too technical. Don't worry from examination point of view. This classification is something which is going to be tested post qualification. I gave a couple of examples which are not that important from your examination point of view. These are all case laws where byproduct which comes out of the main process, bitumen. How do I identify? Shall I classify this liquid, like this tar, damper? When you lay a damper road, the bitumen which comes as a liquid by heating 2-3 components together. Should I call that as a bitumen or should I call as a bitumen emulsion? Now, these are a couple of case laws I've picked up for enthusiastic people who wanted to read and understand. Examination point of view, students, only the theory from types of duties will be tested for you, either 3 marks theory question or 1 mark MCQ. With respect to classification, this is only post-qualification where you will be using this for your understanding purpose. With this, I come to the end of today's discussion. Don't miss the next class. One compulsory question which is tested in your final on valuation, we will discuss in our next class. Till then, see you. Good night. Bye.